Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up companies across the globe. The company has ventured into real estate and construction, stockbroking and finance, ammunitions, mines and many other sectors.
Good evening, ladies and gentlemen. Welcome to Market Today and to a special episode of Market Gurus on. Our guest today is a special fund manager who over the last 3 decades has worked not only in several asset management domestically but also across Asia, in particular Abu Dhabi Investment Authority. Ladies and gentlemen, please welcome Mr. Mihir Vora. He is the Chief Investment Officer at Trust. And over the last 3 decades, Mihir has a very strong on volatility, on momentum investing, as also value investing. To you, Mihir, how do you see the rest of 2024 panning out? What has been a fantastic year for equities, for fund manager, for indices, and for retail investors.
Hi, Shailendra. Thank you for the kind introduction. Always a pleasure to be on your show.
So how do you see 2024 panning out, and what do you think are the kind of returns that retail investors should look forward to in the next 12 months?
Sure. Shailendra, I wish we could have all years like FY24, 23-24. God willing, that should happen. But the point is that you may have seen superb returns on the large cap indices, probably around 30%, on the mid cap indices around 40%, and the small cap indices around 50% returns, in this financial year. So it's been an amazing year. Difficult to replicate, as you can understand. But the good thing is that we do have growth as a tailwind for us, both locally as well as in the global economy. Especially in the US, the GDP growth has been much better than expected, and there have been sharp upgrades to the estimates. So in the US GDP estimates, there have been upgrades to the GDP estimates for India also. So we do see that growth has surprised on the upside, and the traction has been better than expected. So I am still expecting going forward about 15% earnings growth for the Indian corporate sector in the next couple of years. And given where valuations are today, I think we should expect at least good, decent double-digit kind of returns for the next couple of years, even from these levels, especially in large cap sectors.
Okay, ladies and gentlemen, what we'll do is our PCR has prepared a special set of graphics, not only to welcome Mihir on this fantastic show, but also to show you what Mihir has said is a fantastic 1 year that we've had. So you'll see sectoral returns from specific funds along with their benchmarks, and you'll be very pleasantly surprised to see the kind of returns that funds have made for the last 1 year. You have the thematic PSU sector giving a return of 90%. Now hold your breath. The index for this sector is up 100%. The sectoral infra set of funds have given a return of 62%, while the benchmark has appreciated 102%. And then on, the list will keep on going in front of you. So what has been a fantastic year for retail investors has also given us an interesting data that indices, the benchmark indices for many sectors have outperformed a lot of their specialist stock pickers. Mihir, how do you explain this trend?
Sure, Shailendra. So I think a lot of it is to do with the fact that at the beginning of the year, most of analysts and fund managers were expecting things to slow down, especially in the US. And because of that corollary, the markets also to kind of give normal returns. But as the year passed, you actually saw the economy in the US showing amazing resilience.
Yes.
along with higher inflation. So we actually saw a situation where, in spite of rising interest rates, you saw GDP continue to accelerate and earnings estimates in a lot of segments starting to accelerate.
Absolutely.
Because of the initial view at the beginning of the year, a lot of the fund managers were more large cap biased to be on the
Okay.
side of safety in a volatile environment. And to everybody's surprise, it's the mid and small cap segments which amazingly outperformed by a margin. So I think this bias towards large caps is probably what's caused the little bit of underperformance in the category in the last 12 months, which also means that there is ample scope for stock selection, and if we do it right, we can still make up that alpha, I guess.
Okay. Now, Mihir, from now on, let's break this show into two parts. One is what is going to happen according to you in the next 1 year or so, and then we'll focus on trust mutual funds progress in terms of it being primarily a money manager on the mutual fund side and shifting to equity. First things first, what is your bias over the next 12 to 18 months? Do you think large caps will outperform, or is it going to be another year where mid caps and small caps will rule the roost? How do you see the next 1 year or so in terms of outperformers?
Sure. So given the sharp outperformance of the mid and small cap segment in the last year, it's natural to think that large caps will relatively do better in the next 12 months.
Okay.
But one also must put into perspective that in the previous couple of years, it was the large caps which outperformed. So to some extent, the mid and small caps are also catching up. We can say that. So what we have seen is that if the economy continues its pace of momentum of growth, and if we continue to see upgrades, then we might have enough scope for stock picking in the small cap segment. In my view, Shail, typically I think there are about 950 stocks in the market which are of relevance to us, as an institution. Out of these, the top 100, of course, are large caps, and the next 150 are mid caps. But then we almost have 700 stocks after that, which are in the small cap segment. I'm just ignoring the micro cap segment.
Yes.
So just in the small cap segment, I would say there are 700 stocks to choose from. So there is ample scope for stock selection in these 700 stocks, and the large cap indices are anyway not expensive. The top expensive.
Okay.
A lot of scope for stock selection in the small caps, because I'll just explain that a bit in a minute. I think if at all we were to make a general statement, which I'm not very happy doing, but suppose we were to make an overall statement on index, it's probably the middle 150 mid cap where there is a little bit of I would say overvaluation, because per force a lot of institutions are focusing on these 150 stocks for their mid cap exposure. But apart from that, as I said, the top 100, I don't see that much of an issue. And then the next 700 below the mid cap, again in the small cap, I see there is ample scope for stock selection. And
Okay.
if you can give me one more minute, I would like to elaborate on that.
Please
Uh,
continue, sir.
yeah, so I said there are about 950 stocks in the relevant segment, ignoring micro caps, out of the 5,000 stocks. So the whole market is 5,000 stocks. For me, about 950 stocks are relevant, ignoring the micro caps. So if you look at the market cap approximately of these 950 stocks, uh, and these are typically about 2,000 crores in the market cap, the total market cap is about 330 lakh crores.
Okay.
Okay. Out of these 330 lakh crores, about 30%, which is about 90 lakhs crores, 95 lakh crores, is in what I consider high growth segments. The segments which we like, and the segments which we think are going to grow faster than the rest of the economy over the next many years. So, typically the ones that we are looking at is, say, uh, infra, cap goods, construction, real estate, retail financing, defense, railways, chemicals, pharmaceuticals, to me is also a high growth. So a long list of sectors which are likely to go faster than the rest of the economy. So this 30% is what I call high growth. But if I break up these 95 lakh crores by market cap, then almost 70% of this 95 lakh crore market cap is in mid and small. Right? So if I want to get exposure to the higher growth segments of the market, which is 30% of the market, I'm perforce going to go to mid and small caps. That's the reason why I say, I'm not really biased against mid and small caps, even though some of them might look a bit expensive. But
Yeah.
but if you want to be in the high growth segments, you have to be there.
Okay. So, Mihir, it makes the job of fund managers such as yours all the more difficult, given the fact that we've come into the new financial year that will start 4 days from now with a background of very, very strong gains. And from now on, given the way valuations have moved, it makes the task even more difficult to choose. So, what are the 2 or 3 filters? You often talk with me on how themes like gorilla stocks will work. So, what are the 2 or 3 themes which you think you will deploy over the next maybe 6 months or so when you build up a flexi cap portfolio?
Certainly. So, as you brought in the topic of flexi-cap funds, I'd like to mention that we are launching our first flexi-cap fund
Yes.
next month, beginning the 5th of April, ending on 19th. So that's an exciting event for us. But the way to approach, growth investing in India, and we do firmly believe that India is a growth market, is to not only look at growth in the near term, but to look at stocks which we believe have longevity of growth. So, there is one term that we've come across, which is gorilla investing, and that's a very interesting term because it is a form of growth investing, but with a very strong focus on longevity of growth. Very often we've seen that in countries like India, which are on a high growth trajectory, there are certain stocks and segments which sustain their growth for a very long period of time. And we've seen that when stocks sustain high growth rates for a long period of time, the value of the profits beyond the first 5-10 years, the current value of the profits is actually 80% or 90% of the market cap. So while we end up valuing a stock on the next 4, 5, 6 years of profits, the market is actually looking at 90% of value coming on coming because of longer term profits, because the trajectory of growth has been much larger or much longer than expected. So this is what we call terminal value, where in high growth stocks and segments, we tend to horribly underestimate the long term growth potential, which is where probably 80-90% of the value resides. So stocks which look expensive on current PE basis may not be that expensive and may actually be cheap if you look at the growth beyond the longer term. And this is what we call terminal value investing. And the reason why we call them gorilla stocks, such stocks with a long trajectory of growth, is that these stocks are rare to find. They are large, they become dominant because of their high growth rates, and most importantly, they have a long life, which means the longevity of growth is very light. So these are all the characteristics of a stock that we are looking for, and this is what also describes a gorilla. That's why the term gorilla investing.
Okay, Mihir, let's just get this right with an example, because you mentioned that you will be hunting in the small cap and the mid cap space for your flexi cap scheme that should be in place by say 1st of May. Give us examples, even if those stocks may or may not form a part of your portfolio. What is a gorilla stock according to you in the mid cap and the small cap space as of now?
Okay, so the very important point to understand is that gorilla stocks or potential gorilla stocks don't necessarily have to be in the mid and small cap space. We've seen even large companies continue to compound and grow for a long period of time in India, and we have many examples of that. So I mean, but to give you a very simple example, when we look at longevity of growth, it is basically the runway of growth we are talking about. So let's, as an example, let me give you a current example. Today, a lot of the defense stocks have moved up, and a lot of the stocks may look expensive on a PE basis. Okay, but what the market is probably looking at is the longer term. And what is the longer term potential for this sector? First of all, even as we speak, only probably a third of our defense capital expenditure is locally manufactured. And that also after a lot of effort. It used to be probably 20%, now we are at 33% after 4-5 years of efforts. The government has clearly given a direction that a lot more needs to be indigenized. and defense spending is anyway growing at 8 to 10% per year. So the pie will probably double in the next few years. And from 30%, you probably go to 80% domestic manufacturing, both by the private sector and the public sector. So that itself gives you a good visibility for the next 5-7 years, maybe 15-20% growth for a lot of stocks. But what also happens is that once the private sector comes in, which it has now, it was not allowed very freely earlier, you have an ecosystem which will develop for defense supplies. And that is actually opening up the export markets also. So when you talk about the domestic market, it's probably around currently say 3 lakh crores. But the export market can be 20 times the size of the domestic market for defense, So when you say that probably because of the ecosystem developing, the supply chain developing, the whole market opens up as far as exports is concerned, then you are looking at a target addressable market of far bigger than what the current domestic market is. So that is what probably the markets will start discounting at some point in time, and that's what we talk about longevity of growth.
Okay, what we'll do, ladies and gentlemen, we'll show you long-term charts of Hindustan Aeronautics, of Masgaon Dock, of Garden Reach Shipbuilders, as also Cochin Shipyard, where you've seen the kind of runway that Mihir has talked about, and the order flows that are coming in from the government or from various other ministries, as also potentially export orders. This is probably a sector which is a bigger gorilla in the making than what it already is at this point of time. Some of these stocks have gone up 3-4 times over the last 2 odd years. Mihir, why do you start with a flexi cap fund? Why not a thematic PSU choice?
Good question. First of all, Shail, this is our first equity fund.
Yes.
And flexi cap category is the largest category in the equity space in the mutual fund industry. So it's a space we can't not be there. So we have to be there. And second is, as I mentioned, when we are talking about potentially 950 stocks to choose from, we really want to be sector agnostic and market cap agnostic.
Yes.
And better leave it to the fund managers to decide which is the stock with the largest potential upside, irrespective of the market cap, bucket. So I think it's a good open canvas. We can choose the best stocks, and we plan to run a pretty focused portfolio. We are only, while the benchmark is 500, we're probably looking at about 40 to 60 stocks in our portfolio, which makes it a good, actively focused portfolio.
Fair point. I'll just give you the category return that has come in as far as flexi cap funds are concerned. I think they rose about 39% in the 1 year that has gone by. You'll just see the graphic coming in compared with the 40% return that the sector benchmark has given. And I'll give you the breakup also of this return. The top performing flexi cap fund has given a 1 year return of 64%. There are 73 flexi cap funds, and the worst performing fund has given a return of 25%. So you can well see the range of returns that has come in, and given Mihir's stock picking ability, let's hope that he comes into the first upper 5% quartile next year when we get back on flexi cap funds. Mihir, let's now focus on PSUs. Do you think the rally has done enough, and we just might see some profit booking in the rest of the calendar year, or is there more steam left in PSUs?
So Shail, I don't look at PSUs as one bucket. I'm still looking at it sector by sector and stock by stock. So for example, I would continue to be bullish on, say, PSUs related to the power segment, because I think a lot of investments is still needed and will continue to benefit these companies, whether it's on the utilities side, renewable side, or capital goods sides. I would still continue to be positive on some of defense stocks in the PSU segment, because as we discussed, it is a high growth area for India for the foreseeable future. Segments where I think there is continuous or where there is policy uncertainty from time to time are segments which I am not structurally positive on. So for example, oil marketing companies, oil upstream, etc. Are not places where I would be structurally bullish for a very long time. There could be tactical buys from time to time, but not structural. And PSU banks again are a different ballgame. We really need to look at it stock by stock. With the re-rating over the last 18 months, some of the underperformance has been already captured. Maybe some more steam to go. So I'm kind of neutral on PSU banks at this point in time. So as I said, I'm looking at it stock by stock, sector by sector, not PSUs as a bunch.
Okay. Mihir, where do you think value lies in this kind of a market which has on the index level appreciated between 30 and 90% over the last 1 year?
The Shell, broadly, I continue to believe that the domestic linked stocks will do better than the global linked stocks. So, for example, I think IT services may underperform versus the rest of the market. Metals and commodities, I am neutral on. I don't think the acceleration in expected acceleration in China is panning out. So metals and global energy stocks as well as IT, I am a little bit underweight to neutral. Whereas stocks in the say banking space should do better. Banking has underperformed for almost a year. I think that should correct now with great growth picking up. Local investment linked stocks like cap goods, construction, real estate. So basically, physical asset creation linked stocks should continue to do well. And then I think the theme of premium consumption should continue. So whether we are talking about high-end housing or high-end cars and SUVs, or even eating out, travel and tourism, that spending I think is showing a lot of traction, and I think it's structural in nature because of the demographics. So these are some of the themes that we are actively looking at. The one thing that we also like a lot is, and it's still probably underrepresented, is the technological or disruption in technology kind of theme, which is this new business model which have come up. We have seen 4 or 5 good listings in the last couple of years, where the companies are using technology to create new business models or disrupt existing businesses. So that new age companies is a segment where I am quite bullish on going forward.
Okay, that would mean stocks such as Zomato, such as PB Fintech, to some extent, even Nykaa and Honasa Consumer. So this is a theme that Mihir is talking about, not specifically these stocks. I'm just marking them for your understanding. Mihir, the other theme that is going to play out very well is the cut in interest rates. That will benefit money fund managers such as yours, which you have a huge chunk of money invested there, as also themes like autos and real estate. There's just a blowout that's happening in Bajaj Auto, in Maruti, in Tata Motors. How do you explain that rally?
Shail, I have not really able to make a very strong correlation for India, especially between interest rates and growth. India, where people want to buy, they are buying even at higher interest rates. If they're not buying, they're not buying at lower interest rates also. So whether it's car or housing, I think it's more a function of underlying demand and job creation rather than interest rates. If people are not that rate sensitive, a guy will take, if he wants to buy a house, he'll buy a house at 9.5% interest loan or 8.5. I don't think it matters beyond a point. So I think what we are looking for is, sustainability of this job creation and the momentum of consumption. That should be enough rather than interest rates. But having said that, I think the fear in the financials, for example, NBFCs and banks, of margin compression was kind of responsible for some of the underperformance last year. And with interest rates hopefully having peaked out, and second half of the year probably should see interest rates cut coming in, should benefit financials in any case.
Okay, and Mihir, we are running short on time. Sadly, it's time just lapses when I start talking to you. Your 1 year estimate on the Nifty, we are sitting at 22,000 now. Given the fact that the present political dispensation will most likely come back onto the saddle in June, where do you see Nifty from now on, 1 year later?
Always a difficult one, but I'm seeing, let's say my range would be 10 to 15% appreciation from these levels.
Okay, so 10% would make it another 220 points. So you're looking at somewhere like 25,000 to about 26,000 to be on the really conservative side.
Correct.
Right. With that, Mihir, thank you so much for your time. All the best wishes for your new fund launch, which is going to be a flexi cap scheme. Let's hope we get to meet you in June when we'll discuss this lovely portfolio of 40 to 60 stocks that you talk about, which exhibit all tendencies of being an 8,000 point gorilla from now on. Thank you so much, Mihir. Have a nice day.
Thank you so much, Shailendra. Very kind of you. Thank you.
Okay. That, ladies and gentlemen, was Mihir Vora. He is the Chief Investment Officer of Trust Mutual Fund, and his views on the market were there right in front of you. Thank you so much for watching us. Let's hope it turns out to be a great financial year in 2024-25 as it has been in the past 12 months. Thank you so much for watching.
If you follow ace investor Vijay Kedia and his stock selecting ideas, well, there is a new IPO that has opened for subscription, which is actually backed by Vijay Kedia himself.